Well, we are right now looking at an interesting market where in today's trading, investors are shifting back into tech, and that's been one of the fuels of the S&P 500. It's one of the reasons why that American benchmark has outperformed the Canadian market when you look at the last year's worth of performance. At the same time, don't forget, if you go back to last week, there was a pretty dominant narrative about how tech was starting to stall out, and some of the sectors that benefit the TSX have started to find buyer interest. Let's bring in Brian Belski because he covers both markets quite closely. He's Chief Investment Strategist at BMO Capital Markets. Brian, great to see you.
Thanks, Sarah, for having us, and good morning, Canada.
And I guess the story of Canada, how it fits into the market going forward. What do you make right now? I know you're, Brian, last time we spoke, I felt like you were pretty cautious on tech stocks continuing with the surge that we'd already seen.
So for the record, we're overweight tech in both the U.S. and Canada. We just think from a market perspective, especially tech's dominance so far year to date and really since October, that it's gotten a little ahead of itself. Now that's proven to be the correct call the last couple of weeks, although today with the Apple and Google news, we've had kind of a rush back into tech. But again, we really believe that the trend of dominance from the few to the many will actually benefit Canada, especially given its more value and cyclicality in terms of its companies. But we do see an overall broadening out of the market, and I think that's going to be very positive for the overall strength and health of the bull market. Okay, well, with that said, let's just go through some different portfolio ideas you have for stock pickers out there. Tech is often associated with growth. You also like to look at growth versus the value that you're receiving from the company at the stage at which you buy. This idea of growth at a reasonable price. Are there stocks that kind of identify how you think about something like that right now? Yeah, there's a lot of them. And I think that the growth at a reasonable price type of mantra, looking at those companies with PE ratios less than the market, earnings growth more than the market, and a positive earnings growth outlook going forward, because you want to make sure that you're not buying a value trap. You can apply that formula for both looking within the growth indices and the value indices. So I would say some insurance companies in the United States like Progressive, or even names like Oracle in the tech space, given where its cash flow is. Healthcare names like Amgen are a little bit more of a growth at a reasonable price type moniker. And even when you take a look at Canada, when you're looking more for value names that I think that have very strong earnings outlooks, even like a Canadian Tire, we think is one of those names that I think has been kind of lost in the lure as Canadian consumer discretionary stocks continue to do very, very well. Yeah, well, that's an interesting one, too, because they had some challenges in the most recent quarter, but a lot of it seemed to be weather related. So whether or not that's an opportunity over the long term, we'll find out. Growth at a reasonable price is one way to measure stocks. Brian, another way that you like to look at them is through their yield at a reasonable price. We get a lot of people looking at a dividend yield of a company, but you went a step further to look at dividend yields and valuations together. When you look at investments that way, what screens well for you? That's a really key metric we believe in. We've been preaching as strategists now for over 30 years that you just don't look at the yield of the stock. You look at how the cash flow yield is above the dividend yield and how they can continue to facilitate that yield over time. And that's why so many of the banks look great in Canada, whether or not it's BMO, RBC, or TD, with those very strong cash flow yields. If you're looking for more of a contrarian type yield play, we'd look at your parent company, a stock that has been kind of beaten up this year. You had a reduction in force. The cash flow has come in a little bit cheaper, but we're talking about an over 8% dividend yield, and the company's proven that they're going to continue to pay that. So when you're looking at yield at a reasonable price, especially kind of those areas, I'd say in Canada also from a sector perspective, like the utilities and REITs have not done as well as they probably should. And oh, by the way, we continue to believe that rates have likely peaked. It's not that they're going to go back down to 1 or 2%, but we do think rates will settle in the second half of the year, and that should benefit this yield at a reasonable price type trade.
Okay, and before I let you go, I feel like all these roads have been pointing us towards waste management stocks recently. We were talking about how Bill Gates has a ownership stake in One Republic Services. We were talking recently about Waste Connection, a Canadian name that has screened pretty well for investors. And then you were keeping an eye on GFL, which is another player in the waste management business. What is it about the dynamics of that business that caught your eye?
We love the business of waste. We've owned Waste Connections, the old bin, for 12 years. And GFL obviously is a newer comer relative to Waste Connections on the scene in terms of being a listed company. But the company is flat year to date, and they continue from a capitalization standpoint and capital allocation to do very, very well. That's the kind of cyclicality in the industrial space in Canada that we really, really like. And we do believe, like even like a Stericycle in the United States, in the medical waste category is a great mid-cap name. So the overall theme of waste, we think, is underplayed in North American investors, and GFL in Canada, we think, is a very, very timely buy here.
Brian